First trading day in 2024, the bears would call a success. The triple Qs fell almost 2%, Apple was downgraded, falling almost 4%, and much of big tech, well, took a downside slide. Now, Tesla stock reported delivery numbers today, exceeding analyst estimates by about 4,000 vehicles, give or take. And Tesla stock, mainly flat on the day. Actually quite an outperformance compared to Apple, to Microsoft, Google, Amazon, Nvidia, and the likes. But the big question is, what is coming next? I think a lot of people have this question because we've rallied aggressively to enter into 2024. Like the last 3 months were very good for most stocks on our markets, Tesla included, going from 190 to 260 is a pretty impressive rally. What's next? Do we go through a correction period? Do we go through a crash-like period? Is a recession coming? Are recession fears going to grip the markets in a way that they haven't in a while? We also have data coming out tomorrow morning that, well, is very relevant that you need to know. We'll talk about that in this video as well. Let's first briefly explain the 3 reasons why stocks fell today. Number 1 and most impactful was a downgrade from Barclays on Apple. They basically say that iPhone 15 demand looks weak, services are going to slow down, and iPhone 16 sales are going to be low as well. They did lower their price target from $161 down to $160 and put an underperform rating on the stock, meaning they expect Apple to underperform what the triple Qs or SPY do over the next 12 months. So it's not every day that Apple gets a big downgrade like this and falls almost 4%. The effect of Apple falling 4% put direct selling pressure on the SPY and the QQQ because Apple is the most heavily weighted stock in both of those, well, the most popular ETFs. It caused stocks to fall. It caused other big tech names to get sold off because algorithms, number 1, they get a downgrade on Apple, they start selling other stock. But also hedge funds, institutions, and money managers are like, hey, if Apple's getting downgraded, why not Amazon or why not Microsoft next? So a little bit of anticipatory selling definitely happened today. The second most impactful negative event on our markets today is the series of earthquakes in Japan. Now, let me explain this. Back in 2011, there was a lot of market weakness. This double dip recession had a lot of people fearful. But what also happened at the same time was that massive earthquake in Japan. Now, what a lot of people failed to believe, this is the average kind of mentality of your average citizen in the US, and I know every single one of you guys have heard this if you live in the US, China owns us. China owns the US. No, they don't. Actually, Japan basically owns the US. This is because the average citizen believes China owns most of US debt, but it's actually Japan. Japan owns over $1.1 trillion worth of US debt. This is from the Treasury itself, major foreign holders of Treasury securities. Japan's number 1, and then China, and then right behind them is the UK. But whenever there's a problem in Japan, that means potentially Japan is going to sell bonds, and that has financial implications for the US. Now, these earthquakes were relatively small compared to the one that we've seen in 2011 or other ones we have seen in the past. But there's fears that potentially these small earthquakes could lead to a larger one, and that could distort our markets, at least in the short term. And you can see this pretty clearly looking at DXY. This tracks the US dollar. Now, when the dollar goes higher, stocks go lower. Think about it like this. If Tesla is selling a Tesla in the United States for, let's say, $35,000, and let's say they're selling the same Tesla in China for 35,000 equivalent US dollars. It's Chinese yuan. Let's say normally it would convert to $35,000. Well, let's say the dollar does what it did in 2022. Well, when you take in $35,000 of USD equivalent in Chinese yuan, and let's say within a week, the dollar goes higher. Well, you're losing on that conversion. Maybe you're only receiving now, if you're Tesla, $34,700. So it's called an FX headwind. That's what a lot of companies will say on earnings calls. That when the dollar rises, it's bad for company earnings. And it puts pressure on valuations in stocks. That's why from October until now, the dollar's been falling quite a bit. Part of the reason why stocks have done well. Anytime the dollar rallies, stocks don't tend to do that well. Look at basically the peak of the July rally in mid-July of 2023. What happened? The dollar started to rise pretty aggressively. What happened? Stocks sold off almost step by step with the dollar. So the dollar spiked 1% today, which is a very large move for the dollar. Very not common, I guess you'll say. We've seen a lot of like 1% drops in the dollar recently because we've been coming from a high place. But when the dollar rallies 1%, well, it's not great for our markets. And this is caused because of the Japan earthquakes and the distortions, again, in our markets. The third thing that affected our markets today, but not nearly as much as these other two that we've previously mentioned, is the fact that there is now an Iranian warship in the Red Sea. There's US warships in the Red Sea. You are seeing major transportation companies no longer using the Red Sea. So there are some fears that this added about 2 weeks it takes to go around Africa instead of kind of cutting through straight to Europe. That could add some inflationary pressures out there. That could add to costs rising for transporting products. Overall, just make the supply chain a lot more inefficient compared to maybe where it was a couple of weeks ago. And maybe us attacking the Houthis like we just did yesterday. We sunk 3 out of their 4 ships that they were attacking this certain vessel with, that could lead to a broader conflict, okay? I don't think that's affecting the markets nearly as much as the other two things, but that is also worth mentioning. Now, Tesla's stock was pretty much flat today. At one point, Tesla was up, or a couple different points, Tesla's stock was up over 1% today. We did get our delivery numbers today as well. They beat analyst estimates, and I think overall that will have a positive effect on Tesla stock. But you gotta remember, this was only a 4,000 vehicle beat, so it wasn't the biggest beat we've seen before. It was still really good news and still would have had a positive effect on Tesla stock. But I think a lot of analysts and big money, they're really waiting for the next earnings call with Tesla. The next earnings call, we're going to get full year 2024 guidance. We're going to get hopefully some clarity on where margins are going to go and what the pricing matrix, as Gary Black says, is going to be going ahead. Is the long range and the rear wheel drive Model 3 going to get the tax credit back, or is it not going to? Is there going to be some fluctuation of pricing for Tesla vehicles? How is that going to be? Where does Tesla see current demand for Tesla vehicles? We know the US seen some pretty rough demand last quarter in Q4. For the first time ever, China delivered more vehicles than the US, or at least it was pretty close, and normally that does not happen. Even Rivian had really bad demand in the US, so it's not just a Tesla issue there, it's more of a potentially US economy issue there. But overall, if you really think about it, we have not gotten any clarity or answers now for what could be 3 earnings calls in a row if we don't get any clarity or answers this time around. In other words, the last 2 earnings calls have really just been Elon kind of, talking down on the economy, delaying things like the Cybertruck. Giga Mexico didn't necessarily delay the Cybertruck last time, but he said that they kind of shot themselves in the foot. So we really didn't get anything constructive. Nothing about margins, nothing about demand for Teslas on the last 2 earnings calls. The last 2 earnings calls, you could have skipped them and you wouldn't have missed anything important, okay? We don't want to see that again. We want a good old-fashioned earnings call. Analysts ask questions. Elon and the executives answer them. That's what we want, because that will allow more money to position into Tesla. The next earnings call, This upcoming one is going to be January 24th. So it's not going to take too long before we will get some more answers. Now, that is also an important point that I bring up. An earnings call, because we're going to be starting earnings season. Now, a lot of people, big money, hedge funds and institutions, they want to go back into our markets. They do. But a lot of them are pretty concerned around earnings with some of your big tech names. That's a big reason why Apple got downgraded today. This could put some pressure on the indexes until we do get clarity from companies and once we start to get earnings actually coming in. I've actually talked about this for a while now. Theoretically, you could see Apple, Microsoft, Google, Amazon, all of these stocks kind of do nothing or even sell off. And you could see small mid-cap stocks, interest rate sensitive names do well. And that's really what you've seen at some points today. At other points, algorithms kind of took over and the selling really just took over everything. But at one point today, the NASDAQ was down over 1% and the Russell was positive. At one point today, the triple Qs, the NASDAQ 100, was down over 1.5% and Tesla was up over 1%. This was in the beginning of trading today. So that's a trend that might start to solidify itself. You could see inflows to small caps and outflows from big tech. That would cause indexes to fall, but you could actually see parts of the markets do very well. I mean, there was clearly a rotation today. Johnson & Johnson was up 2%. AbbVie was up 3%. CRISPR was up about 6%. Pfizer was up 3.5% today. Healthcare seen a lot of money go into it. And I mean, next time it could be tech, small cap names. But you are definitely starting to see a rotation in our markets. So as to the question, could the indexes come down from here? Absolutely. Absolutely. That's actually my expectation, is that the S&P will at least come down to 466. That is 2022's high, the previous all-time high for the SPY. I think this is almost a guarantee, roughly. You can't make guarantees in the markets, but I think that's a pretty well-known, probably a certainty at this point, right? That would be a little bit of sideways consolidation of the rally that we have seen, and then potentially we could start to, make our way higher after that. But it does seem like a pullback from here is probably more likely than not. But again, that does not mean Tesla stock has to fall. I actually expect Tesla stock will do well over the coming days, weeks, and the next couple of months. Specifically after January 24th, if we do get a good constructive earnings call. Tomorrow, we will have some economic data coming out, in which we'll get into right now. So 10 o'clock in the morning tomorrow, Eastern Standard Time, you will get ISM Manufacturing PMI. You're actually expecting this to get better from 46.7 to 47.1. Now, this is data for the US. We got manufacturing data today. This is S&P Global Manufacturing PMI for the entire globe. It came in at 47.9. This is like the 20th month of contraction in a row. It's been a long time. Manufacturing has not been doing well. The estimate was 48.2, so that probably helped cause some downside as well. We want to see good numbers for the US. We don't want to, have numbers that are indicating we're potentially heading into recession, right? That's the last thing we want as investors in our markets. Now, tomorrow we will also get JOLTS job openings. You're expecting 8.85 million. I want to see in between 8.9 and 9 million job openings, because think about it like this. If the economy is doing well, you're going to have job openings. And the more job openings you have, potentially is a sign of how good the economy is doing. Because if, let's say, Dollar General was looking to hire 3 employees, right? That's probably because Dollar General is doing well. If Dollar General cuts that down to 1 employee and you lose 2 job openings, maybe not a good sign that the economy is doing well. Or maybe Dollar General just looks to hire no employees. They're done. They're slowing down. They don't want to hire anymore. it's a bad sign if you start to see JOLTS job openings fall too much. So that's definitely something I am watching for coming tomorrow. You will also get ISM manufacturing employment, ISM manufacturing new orders, and ISM manufacturing prices paid. Prices paid will also be very important. You are expecting this to come down from 49.9 last month to 47.5 in the month of December. So all of that data will be important, especially JOLTS job openings. Now at 2 p.m. tomorrow, you're going to get the FOMC minutes. Now what this is basically a transcript of what was said at the last Fed meeting. So we may get a little bit more clarity on essentially why the Fed did what they did last meeting, and that went full on dovish. We might have a better understanding of why, but it's not going to give us any forward-looking information. The markets don't ever care about backwards looking information, right? Markets just don't. If you're an investor, you're looking ahead. You're not looking behind us. So the FOMC minutes, a lot of people are going to be, looking for this and waiting for this at 2 p.m. I do as well, and I read the statement, but it's usually something that gives you a reaction initially, and then the markets just go back to doing whatever they were doing on that given day. It doesn't have a big follow-through effect like a Fed meeting or like a non-farm report or CPI report. It's nothing like that. It's not even remotely equivalent to those hard data points or the Fed making policy changes. We will also be getting economic data on Friday, including the non-farm payroll report and ISM services PMI, which will be the most important data of this week, but tomorrow, still a pretty big day. Tesla's option activity was also pretty good. With a positive order value of 62%, you had 775 hedge fund institutional trades totaling $1.27 billion. Some good news today. Nick Timiraos, widely seen as the Fed's mouthpiece, says the New York Fed's measure of underlying inflation, the multivariate core trend rate, ticked down to 2.3% in November from a downwardly revised 2.4% originally reported as 2.6% for October. This was the lowest reading since the end of 2020. And if you want to get the information first, go ahead and follow Michael Tyler on X. Ryan Dietrich writes on X, it's good to remember that the average peak to trough correction per year is 14.2% since the 80s for the S&P 500. Last year, stocks had a 10.3% correction, yet still gained more than 24%. Takeaway is even strong years tend to see some scary moments. I mean, just take a look at 2009. The pullback was 27.6%, but you actually ended up over 20% that year. Take a look back here in 1998, a 19.3% pullback. You closed the year up over 20%. Same is true for most of these years, a matter of fact. Even what we've seen in 2020, you had a pullback of 33.9%, ended the year up over 10%. So if the average pullback is 14%, that would put you down to about 404 on the SPY. I don't think we're going to go that low personally, but could we fall? Of course. But that does not mean your average stock needs to underperform or even go through nearly a 14% pullback. A matter of fact, the S&P 500 outperformed the equally weighted index by 12% last year, the second biggest outperformance on record with data going back to 1971. Only 1998 was bigger at 16%. So you could theoretically see like a 12% pullback in the SPY and just get down to where equally weighted stocks already are. So could you see a pullback in the broader indexes and see average stocks, equally weighted stocks, do well? Of course, and that's going to happen most likely. Tom Lee, this guy, was the only guy that got the 2023 stock market prediction correctly, and he, down to the almost cent, got his target correct on the S&P 500. Around 475 was his end of the year prediction. He says small caps could rally 50% in 2024, and every single month could be green. meaning we really don't see a large pullback. The reason he's bullish on small and mid-cap stocks is because of interest rate sensitivity and low valuations. I can make the same argument for Tesla. Tesla is very interest rate sensitive, and on Tesla's valuation metrics, it's trading at the cheapest prices it's traded at ever before. The lowest PE multiple. But here's to give something to the bulls as well. The IMF chief, the International Monetary Fund, said the Fed is definitely achieving a soft landing. The market on close imbalance was 7.4 billion to the buy side today. So that means the last 10 minutes, there was a lot of buy orders that came in today. That usually means you can see quite a turnaround the next day after a major sell-off when you get a number this large. A matter of fact, this is one of the largest market on close numbers that I have ever seen. I've seen 10 billion before, but 7 billion is really high. 3 billion is considered high. 7 billion, that's extremely high. And I'm sure this was the reason for the end of the day rally in your major indexes, IWM, SPY, and the triple Qs. So really, if I boil this down, I'm not going to sit here and forecast some epic crash before we get new information. The bottom line still remains. Downgrade or not on Apple, conflict in the Middle East, or earthquakes in Japan, our markets are not going to just all of a sudden start to collapse on that information. No, there has to be something bigger than that. It has to be recession fears. It has to be big tech missing earnings. Something along those lines. So that narrative of a recession could develop if tomorrow's data is bad, if Friday's data is bad. But we're not quite there yet, and I'm not confident enough to project that as well. I'm not going to sit here and say the economy is rapidly deteriorating and we're heading into a recession within the next 3 to 6 months. I'm just not going to say that. Some people will, but I think that would be lying to you. But again, in the near term, could we see a crash correction, some form of pullback for the broader indexes? Yes. Does that mean Tesla or other stocks need to fall? No. I think a sell-off would broadly be concentrated in your big tech names, your Magnificent Seven, excluding Tesla. Let me know what you think about all of this information. Are you bullish? Are you bearish? Are you buying puts? Are you buying calls? What are you doing in your portfolios? Let me know down below in the comment section. As well as that, what do you think the data is going to look like coming out tomorrow also? My name is Michael Tyler. If you guys want to come trade with us live in real time, we did make a trade playing for a potential bounce back in small and mid-cap stocks. Check out that link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.